Well, two iconic brands, two countries, one merged tax strategy. Burger King is in talks to buy Tim Hortons. This is the Canadian coffee and donut chain. If the deal goes through, the combined company would be headquartered in Canada. Another one of those so-called tax inversions, which could lower Burger King's tax bill. Both companies trade in the U.S. and both surged on the news of the possible deal. Burger King shares rose 19.5%. Tim Hortons jumped about 19%. But Sarah Eisen reports there may be more to this proposed merger than just lower taxes.
It doesn't get more all-American than the Whopper. Or maybe not. Burger King may soon become Canadian. The company confirming it's in talks to buy Tim Hortons, a Canadian coffee and donut chain. If the deal goes through, Burger King would move its headquarters from Miami to Ontario, adding fuel to the inversion debate in Washington, where companies, mostly in the healthcare sector, have been pursuing mergers and acquisitions outside the U.S. to take advantage of lower corporate taxes overseas. Canada has a 15% corporate tax rate, much higher than the 35% rate in the U.S.
If you look at the effective tax rate from last year, they were both roughly 27%. Over time, the statutory rate for Burger King should move toward 35%, and then the statutory rate in Ontario is 26.5%. So it's more of a long-term tax saving. In the near term, it wouldn't matter that much, but longer term, yes, they should.
Beyond the tax advantages, analysts say there are other reasons for Burger King to do this deal, like international expansion. Tim Hortons has nearly 80% of its business in Canada. Burger King's wide global reach, with outlets in Africa, Asia, and the Middle East, could help fuel growth. Analysts also point to Tim Hortons' attractive product lineup: coffee and donuts. Breakfast is a growth area for fast food. We've seen Taco Bell, for instance, launch the breakfast waffle tacos to go after a piece of McDonald's breakfast business. Tim Hortons could help Burger King compete. Coffee is also a high-margin, attractive business, and Tim Hortons is a cult favorite.
Top-line growth at Tim Hortons U.S. grew more than 15%, driven by a mix of strong new unit growth as well as strong same-restaurant sales growth. That's the kind of growth you really don't see in the quick service category. I think having that would be a key advantage for Burger King.
No question, relocating because of tax advantages is a big part of this story, especially with Walgreens opting out of an inversion to relocate to Europe because of political pressure. Walgreens staying in the United States. Treasury Secretary Jack Lew has called these deals unpatriotic. President Obama has called the companies corporate deserters. That's why if a deal does go through with Burger King, it could add further urgency and speed up reform on Capitol Hill to do something about it. For Nightly Business Report, I'm Sarah Eisen.